The silver price on your screen is lying because the real signal this week is in the premium, and it just snapped higher again. Not because the world ran out of silver, not because one headline magically changed physics, but because the market is being forced to reveal where the metal actually is and where it isn't. And here's the part most people miss. Premiums don't jump randomly. They jump when the chain between paper price discovery and real-world delivery hits a timing wall. Stay with me, because by the end, you'll have a clean checklist for what to watch over the next week or two, the levels that matter, and the one hidden pressure point that turns a normal dip into a violent squeeze. Let's get brutally clear on what we mean by premiums rising, because this is where people get fooled into arguing the wrong fight. Spot is the reference. It's the big, wholesale institutional quote. The price at which metal can theoretically change hands for immediate delivery in the professional system. Your premium is everything it takes to transform that theoretical ounce into a real purchasable product in the real world. Fabrication, refining schedules, shipping, insurance, dealer inventory risk, hedging costs, and this matters. Availability right now, not sometime later. And when premiums rise across multiple products at the same time, that's not just a retail mood swing, that's the supply chain voting. That's the market whispering, yes, the quote exists, but good luck getting the form factor you want at the time you want without paying up. And that's where the real pressure starts. Now, we need price context because everything in silver is a knife fight with a calculator. As of January 19th, 2026, spot is sitting around the mid-90s per ounce, and it didn't stroll there politely. It lunged. Just a week ago, prints in the low to mid-80s were still on the table. That kind of jump does two things at once. It yanks attention back into the market, and it stresses the plumbing. Volatility rises, liquidity thins, market makers widen spreads. Dealers get nervous holding inventory that can gap against them overnight. And the public looks at the chart and assumes the price move is the story. But price is the headline, the premium is the body text, and the body text is getting darker. Here's the street symptom that matters more than any influencer thread, the slow creep of friction. Delivery times that quietly extend, in stock that turns into ships in 10, 15 business days, purchase limits that suddenly exist on the most popular items, generic bars that are available but specific sovereign coins that aren't. A bigger difference between what a dealer will sell for and what they'll pay you for. None of those things show up in a clean candlestick chart. But together, they're the smell of a market that's acting short, meaning it's acting like near-term supply is tighter than the paper quote implies. And that's not the part that matters yet. The next detail is what flips the whole setup. Because the hidden driver this week isn't mystical, it's the calendar. In precious metals, especially silver, timing is a weapon. When you move through contract rolls, delivery windows, option expiries, month-end and quarter-end positioning, you're not just watching price. You're watching forced behavior. Funds have to roll exposure, dealers have to rebalance hedges, manufacturers and fabricators have to decide what inventory is working inventory and what inventory is risk. And when those decisions bunch up in the same short window, premiums are often the first place the stress leaks out. That means why you can get the seemingly weird combo of spot up and premiums up even more, or spot flat, but premiums jump anyway. It's not mood, it's math. And if one level breaks, the math changes. So let's pull apart the mechanism cleanly, without the tinfoil and without the bedtime story. The professional market trades big units, large bars, standardized forms, deliverable against contracts in approved locations. Retail demand lives downstream, coins, rounds, small bars, specific brands, specific finishes, specific packaging. Between those two worlds sits the transformation layer. Refineries, fabricators, blank producers, mints, logistics, and inventory finance. That layer has capacity limits and lead times. It doesn't scale instantly just because price goes vertical for a week. And when price rips, two reflexes kick in simultaneously. Retail buyers rush because they don't want to miss it, while dealers get more cautious because holding inventory in a vertical market is like holding nitroglycerin. They hedge, they widen, they ration. That wedge between paper and physical widens. Premiums rise. And everyone argues about whether it's fair, while missing what it signals. Immediate availability is being repriced higher than theoretical supply. Now, if you want to see stress before it hits the headline price, you don't stare at spot like it's a crystal ball. You watch the curve and the spreads. Term structure is the market's body language. When the near months trade richer relative to later months, when the curve flattens or flips, that's the market saying, metal now is more valuable than metal later. That's not a conspiracy. That's a funding and inventory signal. It can reflect tight nearby supply, high convenience yield, or simply a scramble for immediate hedges. In silver, it can also reflect something uglier, a mismatch between who needs the metal now and who is willing to part with it now. And when spreads start screaming, premiums often follow because the entire chain reprices for urgency. but that's still not the full trapdoor. Here's another underappreciated piece: inventory categories. People throw around inventory like it's one big bucket. It isn't. In the professional system, a lot of metal is present but not available. Some of it is tied up in financing trades. Some of it is earmarked. Some of it is held as working inventory for industrial users. Some of it is sitting in forms that aren't immediately convertible into what the buyer wants. And even in venues that track deliverable supply, there is a difference between metal that could be deliverable and metal that is registered and ready to go. Conversions are possible, but not automatic and not free. Friction matters. Paper markets can pretend friction doesn't exist until the moment somebody needs actual delivery on a schedule, and that's where the real pressure starts. Now add the institutional constraint layer: margin, volatility, and risk limits. When silver gets jumpy, clearing firms demand more collateral. Brokers tighten. Position sizes that were comfortable last month suddenly become uncomfortable this week. That triggers forced behavior, especially for leveraged participants. Shorts feel heat because losses accelerate. Longs feel heat because volatility can trigger risk reduction even in winning positions. This is how you get the market doing something that feels insane to normal humans: selling hard into bullish fundamentals or pumping violently into thin liquidity. It's not insane, it's risk management. And when that happens, at the same time, dealers are trying to keep inventory light and hedges tight. You get the perfect cocktail for premiums to rise: more demand for immediate product, less willingness to warehouse risk, and more cost to hedge the exposure. The next detail is what flips the whole setup. Let EY talk about round numbers and options without turning this into a derivatives lecture that kills watch time. In silver, big psychological levels, like $90 or $100, matter because exposure clusters there. Options strikes attract positioning. Dealers who are short options hedge dynamically, and that hedging can amplify moves. Here's the simple version. When price rises toward heavy call strikes, dealer hedging can turn into forced buying to stay neutral, which adds fuel and can create a reflexive loop. When price falls away, hedging can flip the other direction, accelerating downside. That's why silver can feel like it has no chill. And it assumes why premiums can rise even during scary pullbacks. The physical buyer sees the dip as a chance, while the dealer sees the volatility as a reason to charge more. Two different worlds, two different incentives, same metal, and if this one level breaks, the math changes. So what actually changed in supply this week? Not the Earth's crust, not some magical mine shutdown that instantly removed metal from the planet. What changed is the availability of finished product relative to the pace of demand, inside a timing window where the system can't smoothly absorb shocks. Fabrication schedules and mint output aren't infinite. Blanks and planchets have their own bottlenecks. Refinery throughput isn't a faucet you twist. Logistics have lead times, and higher prices can increase insurance and working capital costs in a way people underestimate. Meanwhile, a fast price rise encourages a behavior that sounds bearish but is actually tightening in the near term: withholding. Holders become less willing sellers because they don't want to be the person who sold the last bar before the next leg. That reduces float. Float reduction is a supply event in practice, even if total above-ground silver hasn't changed. And that's not the part that matters most. The part that matters is how the market responds when it meets that reduced float with a calendar-driven demand pulse. Now let's stack proof, because one argument is a vibe. 5 arguments is a thesis. First proof point: spot has moved fast enough into the mid-90s that inventory risk is no longer theoretical for dealers and market makers. Fast ramps widen spreads and raise the cost of immediacy. Second proof point: physical market symptoms, delays, limits, selective out of stocks, are consistent with a downstream bottleneck, not simply people buying more. Third proof point: term structure and spread behavior often tightens in nearby windows when the system is repricing for urgency and financing. Fourth proof point: inventory categories and deliverability friction mean there's plenty of silver can be true in aggregate, while there's not enough of the right silver in the right form. Right now is also true. Fifth proof point: institutional constraints, margin, volatility, risk limits create forced behavior that can whip price while simultaneously pushing premiums higher through hedging and inventory policies. And I'll add a sixth because it matters. Transparency data from major vault ecosystems can show large totals while still masking the distribution problem. The headline, "Tonnage," doesn't tell you what's available at the margin this week. But that's not the part that matters. The next detail is what flips the whole setup. Because here is the paradox that confuses people. You can have rising vault holdings and rising premiums at the same time. That sounds impossible until you understand that the market is not one pool. It's many pools, connected by pipes with valves. Some pools are deep but restricted. Some are shallow but tradable. Some are industrial. Some are investment. Some are offshore. Some are onshore. And during calm markets, the pipes flow and the price acts like one unified system. During stress, the valves tighten. The pools stop equalizing smoothly, and premiums are the price of crossing from one pool to another. That's why paper versus physical isn't a morality play. It's a logistics and finance reality. The price is lying, and the spread is telling the truth. Now let's zoom out to the macro, because silver is never just silver. Silver is a metal, yes. It's also a monetary narrative, yes. But most importantly, it's a macro barometer that reacts to regime shifts in rates, currency stress, and geopolitics in a way that can be savage. When markets smell instability, whether it's in fiscal policy, trade policy, or the credibility of institutions, hard collateral gets repriced, not in a straight line, in waves. And silver is the volatile sibling in the precious metals family. It can lag and then sprint. It can get ignored and then become the only thing anyone talks about. That makes it perfect for squeezes and perfect for shakeouts. Which is why rising premiums right now aren't just a coin shop curiosity. They're telling you something about urgency, trust, and the desire to hold something that isn't someone else's promise. And if one level breaks, the math changes. But we're not doing blind hype here. We need counterpoints, because the market will punish anyone who treats a bullish thesis like a guarantee. Rising premiums can be a late-stage symptom as well as an early-stage signal. If prices get too high too fast, demand destruction is real. Industrial users can hedge, substitute, or delay. Retail buyers can freeze when sticker shock hits. Scrap and recycling flows can increase with a lag, adding supply at the margins. And critically, the paper market can engineer brutal drawdowns through normal mechanics, profit-taking, margin-driven liquidation, and dealer hedging flows that flip from supportive to suppressive. None of that invalidates the structural story by itself, but it does mean this. Even if the thesis is correct, price can whip around violently. You need a trend signal lens and a noise lens. Otherwise, the volatility will emotionally manipulate you into doing the exact wrong thing at the exact wrong time. And that's where the real pressure starts. So let's build your viewer psychology shield. Because if silver is going where the mechanics suggest, the market's job is to make you emotionally unfit to hold it. It will do it with 3 weapons. Weapon 1, the fake breakdown. A sharp drop through an obvious level, just enough to trigger stops and panic, followed by a violent rebound. Weapon 2, the headline ambush. The story drops at the worst moment, everyone sells first and asks questions later, then the narrative changes after the damage is done. Weapon 3, the grind-up frustration. A slow, choppy climb that makes you bored and overconfident at the same time, so you size too big right before the next shakeout. The antidote is not bravado. The antidote is process. You watch the things that are harder to manipulate in the short term, premiums across products, nearby spreads and curve behavior, and signs of inventory friction. Then you separate what you feel from what the market is forcing participants to do, because if this one level breaks, the math changes. Now let's get concrete about what comes next, because that's what your audience actually wants. Over the next week or two, you should think in 2 scenarios. Scenario 1, controlled pullback and retest. Silver chops lower or consolidates, maybe revisits the high 80s or low 90s zone, and tests whether buyers step in without premiums collapsing. In this scenario, the bullish thesis stays intact if premiums remain sticky. And spreads don't fully relax, because that means physical urgency and hedging demand are still present even as paper cools off. The confirmation would be higher lows in spot, stable to rising premiums, and a curve that doesn't suddenly normalize into comfortable contango. The invalidation would be different. A sharp premium compression alongside a breakdown in spot through a key support zone with follow-through and improving liquidity, meaning the market is no longer paying for immediacy. That would suggest the squeeze pressure is easing. Scenario 2, continuation squeeze and gap risk. Silver pushes toward the $100 magnet, and the market starts doing that thing it does when positioning gets trapped. It moves in air pockets. In this scenario, you'll see premiums pop again, not because dealers are mean, but because they're protecting themselves from being cleaned out at the worst possible time. You'll see intraday ranges expand. You'll see pullbacks that barely last before getting bought. And you'll see the psychological warfare intensify. It's over. It topped, right before another leg up. The confirmation here is simple. Price holds above the mid-90s region on dips, premiums stay elevated or rise, and the market keeps snapping back quickly after sell-offs. Classic reflexive behavior. The invalidation is also simple. A failure near $100 that turns into persistent distribution, with premiums falling and spreads relaxing. Because if the market stops paying for metal now, the squeeze narrative loses its oxygen. And that's the part that matters. Now, I'm going to give you a near-term checklist that doesn't depend on you being a chart wizard. 1, watch premiums on the most liquid retail products you care about. If spot dips and premiums don't, that's a physical bid signal. 2, watch whether dealers widen buy-sell spreads dramatically. That's a risk signal and often happens when they're hedging into volatility. 3, Watch for sudden changes in delivery times or pre-order language across multiple vendors at once. That's friction showing up. 4. Watch the behavior around round number levels like $90 and $100, not because the number is magical, but because flows cluster there and the hedging mechanics can accelerate. 5. Watch your own emotions like it's a position. If you feel euphoria, you're late. If you feel despair, you might be early. The market loves to harvest feelings. Don't feed it. And here is the final revelation, the one metric everyone must watch if you are trying to understand what changed in supply this week. It's not the headline spot price, it's the wedge between what paper says silver is worth and what the physical market demands for immediate, deliverable, finished product. That wedge is information. It tells you where stress is building, where participants are being forced to act, and whether the move is being confirmed by real-world tightness or merely by speculative heat. And right now, that wedge is widening again. That's not a guarantee of straight-line upside. It's a warning that the system is repricing urgency. So here's how you keep this finance credible, not hype. You assume volatility will be used against you. You assume pullbacks will be violent even in a bull trend. You distinguish between trend signal and noise. Trend signal is premium staying firm, spreads staying tense, and dips getting absorbed. Noise is intraday chaos, headlines, and the emotional roller coaster. If you can hold that frame, you stop getting played by the market's theater. And that's where the real pressure starts. On the other side, not yours. Near-term levels, keep it practical. The mid-90s zone is your battleground. Hold above it on dips, and the squeeze case stays alive. Lose it hard, and reclaiming becomes the test. The high 80s to low 90s zone is where a healthy retest could live without breaking the bigger structure. If, and only if, premiums don't collapse with it. And $100 is the magnet in the battlefield. If price gets there, expect the loudest narrative warfare and the sharpest intraday reversals, because that's where positioning tends to get emotional and hedging flows can get aggressive. But that's not the part that matters most. The part that matters is whether the physical market keeps charging for immediacy while the paper market tries to convince you everything is normal. And if you're the kind of investor who actually wants to survive this, who wants mechanisms, not memes, then you're already in the right tribe. Not because we agree on a direction, but because we respect process over prediction. Keep your sizing sane. Respect that silver can drop 5% in a day and still be bullish on the month. Don't confuse a shakeout for a thesis break, and don't confuse a rip for a free lunch. The market will happily hand you a winning thesis and still take your money if you manage risk like a tourist. So as you watch silver premiums rise again this week, remember what changed. Not the existence of silver, but the availability of silver, right now in the form people actually want, inside a calendar window that forces real decisions and punishes hesitation. That's the hidden detail. That's the mechanism the mainstream misses when it reduces everything to one spot quote. And if you track that wedge, premium plus the signs of nearby stress, you can all see the next move forming before the crowd does. Because if this one level breaks, the math changes, and the market can't unsee it.